everyone, welcome to my channel. This is Easy Accounting Channel. Today we are continuing on our Registered Education Savings Plan, RESP. So let's talk about the anti-avoidance rules for RESP. So effective from 22nd March 2017, the budget proposal to extend the anti-avoidance rule governing the register plan to the Registered Education Savings Plan. So the rules provide for a special tax on certain advantage that unduly exploits the tax attributes of RESP. So tax payable on non-qualified investment effective March 22nd, 2017, if the RESP trust acquire property that is non-qualified investment, if previously acquired property become non-qualified, a tax is imposed on the subscriber of the RESP, and the tax is equal to 50% of the fair market value of the property at the time it was acquired and it became non-qualified. Obligation of the RESP promoter. So the budget proposal that after March 22nd, 2017, the promoter of an RESP must exercise care, due diligence, and skill of reasonable, prudent person to minimize the possibility that a trust governed by the plan holds a non-qualified investment. If the promoter fails to comply with this obligation, the promoter is liable to a penalty under the ITA. So changes to the tax treatment of RESP for investment acquired after March 22nd, 2017, that ceased to be qualified investment. The budget proposal to repeal the 1% per month penalty imposed on an RESP trust that holds a non-qualified investment. So tax payable on an advantage reporting requirement by the RESP trust. So the financial institution that are required to report information to CRA and the subscriber when an RESP trust begin or cease to hold a non-qualified investment in a year. Financial institution must, by no later than end of February in the year following the year in which the non-qualified property was acquired or previously acquired and it became non-qualified, provide relevant information to the CRA and the subscriber, the date that the non-qualified was acquired or disposed, and the RESP contracts and account number. And this information is necessary to enable the subscriber to determine the amount of any tax payable on the RESP. So if you determine that a particular non-qualified investment held by your RESP trust is also a prohibited investment for RESP trust, you contact your promoter. So tax payable on prohibited investment after March 22nd, 2017, if the RESP acquired investment and previously acquired property become prohibited, the investment will be subject to a special tax equal to 50% of the fair market value of the investment. The subscriber is also liable for the 100% advantage tax on the income earned and capital gain realized on the prohibited investments. And the 100% advantage tax applied to the income earned and the portion of any realized capital gain that acquired March 22nd, 2017. So tax payable on an advantage. So a 100% tax will be applied to the transaction, the income earned and the capital gain after March 22nd, 2017. So if the subscriber or a person not dealing at arm's length with the subscriber was provided with an advantage in relation to the RESP, the tax is payable, which is the case of a benefit and the fair market value in case of a loan, a death, or a registered plan strike. Exceptions. The advantage rule will not apply to benefit related swap transaction completed before 2022 and is undertaken to remove a property from an RESP, where it is reasonable to conclude that tax related to advantage prohibited and non-qualified investment will be payable if the property was retained in the plan. So refund of taxes paid on non-qualified or prohibited investment. So if the RESP trust disposes of a non-qualified or prohibited investment, you report it in Part A and B of Form RC 339, individual return for certain taxes for RRSP, RRIF, RESP, or RDSP. How to claim refund? To claim your refund, you must send a letter explaining why you are requesting for a refund, and you attach all the appropriate documents detailing the information relating to the acquisition and disposition of the non-qualified or prohibited property. And the document must contain the name, description of the property that was acquired or that became non-qualified or prohibited property. And now to request for a waiver or a cancellation of taxes. CRA may waive or cancel all or part of the taxes if this determine it is fair to do so after reviewing all factors, including the tax arises because of reasonable error, the extent to which the transaction or series of transactions that give rise to the tax also give rise to another tax under the Income Tax Act, and the extent to which payments have been made from the RESP. So the waiver is limited to tax paid under the anti-avoidance rules and not taxes paid under any other part of the Income Tax Act. So you can send your letter to Canada Revenue Agency, Winnipeg Tax Center, P.O. Box 140000, Station Main, Winnipeg. Thank you for coming to my channel. I hope to see you in my next video. Please subscribe to my channel and share my video. Thank you.